Hi everyone, and welcome to today's NOVA presentation, Cash Balance Plan for Advisors with Phil Allen and special guest Scott Kennedy. Before we dive in, I want to point out a couple of features on your webinar screen. First, the question mark icon at the top. This is where you will enter any questions you have for Phil. Feel free to submit your questions at any time. Please keep in mind the Q&A portion of the session will be held at the end. If time runs out and you still have questions, please send them to our email address, webinars@nova401k.com, and we'll follow up with you. Next to that, you'll see a paper icon. This is where you can find the PDF handout for today's session. It will be uploaded shortly. If you're unable to view or download the file, no problem. Just email us and we'll send it over to you. If you are with us today to earn continued education credits, please be sure to stay until the end to fill out our pop-up survey. This will allow us to track your time participation. Certificates will be sent out within a week for those who have not met the time requirement. To view any webinars you may have missed in the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is nova401k.com/webinars. Thank you again for joining us. I would now like to introduce today's presenters, NOVA's Director of DB Client Relations, Phil Allen, and NOVA's Divisional Sales Leader, Scott Kennedy, with a special announcement at the end.
Thank you. As Ava mentioned, this webinar is on cash balance plans, and we are going to be basically giving you a pretty high-level view of cash balance plans. Here at Nova, we love cash balance plans. We love helping clients implement them and get the huge tax deductions and savings. So we'll go through what that means. Let me make sure my slides are working here. Okay, we have our typical disclaimer. We are not CPAs or attorneys. I'm actually an actuary, which means I'm the furthest thing from a CPA or attorney. This presentation is not legal advice, so consult your accountant or attorney for legal advice. If you need CPA credit, our provider number is 009820, and follow the rest of these steps to receive your credit for CPA credit. This presentation is intended primarily for financial advisors, also clients, CPAs. We don't have a ton of prerequisites. Basically, if you've heard of a 401k plan, you're qualified to listen to this presentation. If you've never heard of a 401k plan, you're still welcome to listen to this presentation. We're going to talk about all retirement plans, but then we're going to dive deeper into what cash balance plans are. So I'm going to start off with just kind of a little teaser to whet your appetite on what a cash balance plan could do for you or your clients. I'm going to walk through different retirement plan types. We'll dive a little deeper on cash balance plans because that's the meat of this presentation. We have some frequently asked questions we will run through, and then Scott will pop in with an announcement. So you will want to stay till the end to hear about our exciting announcement. We are not going to touch on Secure Act 2 law changes that affected DC plans. There are plenty of webinars out there, including plenty of them from Nova, so feel free to go to our YouTube channel to check out some of those. So if I were to tell you as an advisor or a CPA or even as a client that I can get you a deduction of $250,000 to $300,000 tax deduction, and it would only cost you for staff about $1,000 in cash balance and 7% of comp, I would hope that really would pique your interest. And that's what we're going to cover today. And that is the value of a cash balance plan. It's a way to supercharge your tax deductions because it's a qualified retirement plan. And you have more flexibility and bigger numbers than what you can get in your traditional defined contribution plans. So who should be interested in cash balance plans? Sorry, my screen is hopping. Um, so primarily professional service organizations, they tend to like these mostly because those are typically groups with steady income and want or need large tax deductions. Owner-operated businesses will see why it's helpful if the owner is over 45. You get more bang for your buck the older you are. If you have a company that's transitioning from an older owner to a younger owner, this could be a way to maybe um, make that transition happen cleaner. You could have the younger owner make the contributions to the cash balance plan, and the older owner could take the cash balance plan when they sell the company, and it's in a retirement plan as opposed to in cash. And then in the rare case where you have a large company, if they're already out there who really want a retirement plan, a defined benefit retirement plan for their employees, then um, this this is something that might appeal to them because it's much more easy for employees to understand uh, the cash balance plan versus a traditional defined benefit plan. And I'm sorry, but my computer is reconnecting to our internet. So I will talk about the next slide, but hopefully it'll pop up before I'm done. So we're going to start going into retirement plans and the value of retirement plans. And the the the, the value for qualified retirement plans is it allows for tax deferral, which also which includes things like a current tax deduction for the employer, um, deferral of income tax on investment income in the plan, and distributions are typically taxed as ordinary income, and it also has protections from creditors. I am going to see if I can open this presentation in a different screen. Just give me 1 second here. I know our company is having network issues right now, so I think that's tripping us up.
Hey, Phil, not sure if you can look at your email. I emailed you the slides.
Okay, it's unfortunately it's not letting me pull up anything on my screen, but okay, let me let me do that. Bear with us for a minute. I'm not seeing them in my email.
My computer may have crashed before it sent.
Okay, we're gonna, I think I have the PDF open. So let's try this. Can you see the slides now?
Yes, we can.
Okay, great. All right, we're back online. So as I mentioned, this was the slide that I talked about that you couldn't see, but basically there are tax advantages to qualified retirement plans. So when we're working with clients on their retirement program and we're setting up their retirement plan, there's usually two main drivers that tend to conflict with each other, and that is the biggest deduction that they can get, the best bang for their buck versus complexity in the plan. And oftentimes those two goals conflict with each other. And so we like to think of ours, as we're doing this, we like to kind of think of this as kind of a ladder. I don't know if that's the best analogy, but it's the best one I could come up with today. And basically, as you go up the ladder, you get higher and higher tax deductions, but the complexity of the plan tends to get bigger. So the plans become more complex as you go up. Cash balance plans, they sort of fit in the sweet spot. So I wouldn't say that they're at the tip of the ladder. Traditional defined benefit plans might be at the tip, but cash balance plans, you get the big deductions, but they are less complex. So that's the huge advantage of them. So in using this ladder analogy, we're now going to flip the ladder upside down just for this one slide. And the way I've listed the plan types out on this slide is kind of in the order of complexity. So you have your SEPs and your simple IRAs at the bottom of the ladder. They're the easiest to understand, but they're also the most restrictive with respect to deductions and that sort of stuff. Then we go on to profit sharing 401k plans with Safe Harbor, ESOPs, new comp plans, DB plans, cash balance plans, and then the cash balance combo plans. All the items that are in bold on this slide that we're going to touch on. So the ones that aren't, we are not going to cover in this presentation. And some of these we're going to just very, very briefly touch on. So cash balance plans, I don't know if this is a true statement, but it sure feels like a true statement. I would guess that cash balance plans are the one of the, if not the most rapidly increasing retirement plan out there as far as new plans getting put into place, percentage wise. We see a lot of cash balance plans getting put in, and I think that's across the board. I think many other TPAs are seeing the same thing, and the biggest reason is because for the right demographics, you might be able to get an owner of 3.9 million in tax deferrals for a business owner, which is very appealing. And as I've alluded to throughout, cash balance plans are easier to understand not only for the owner and the advisor, but also for employees who might be in the plan. So, what's the catch? Well, there is a catch, right? That the government's not just going to hand out $3.9 million of tax deductions and say, congratulations, here you go. You can do that for the owner and you can and do nothing for your staff. The catch is you got to give your staff something if you have staff. Um, and there's non-discrimination testing that is required to be done for all these tests for all these plans, including defined contribution plans. You still, even in the defined contribution plan, you're not allowed to discriminate in favor of the highly compensated employees. And the cash balance plan, when you add a cash balance plan to the equation, then you do have to give staff a little more benefit in either the cash balance plan or another plan, which we will see on subsequent slides. So this is the role that Nova plays on our cash balance plans. Is we're running the non-discrimination testing and making sure these plans are in compliance, and that's the bulk of, as Ava mentioned, I'm the director of DB client relations, and that's the bulk of what my teams do. Is I have a team of actuaries that performs the non-discrimination testing and the funding requirement calculations for the cash balance plan, and then we have account managers who service all of these plans, who are dedicated combo cash balance DB plan experts. So I will refer to, actuaries cannot put a slide deck together with the two rules for actuary slide decks are there has to be numbers somewhere in there, and there has to be some sort of acronyms in there. So I will attempt to define all the acronyms in here, but if I miss some and you don't know what they are, feel free to shoot us a question. But one of the acronyms you will see is ADP or ACP test. You may have heard of those on DC plans, but they are, in fact, I think I talk about them on a later slide. Well, we'll get to those briefly, but that's, I think that's the first acronym so far that you've seen is the ADP test. So typically when you have a profit sharing plan, that the maximum required contribution that you have to give employees to, if you want to max out the owner, is 5% or less. For a cash balance plan, when you combine it with a DC plan, typically what we see, and it varies based on the demographics, but kind of the most common that we see is a $1,000 cash balance benefit and a 7% profit sharing. That's usually where we start the conversations with potential clients. Is we say, would you be comfortable giving your staff 7% of pay as a contribution in a profit sharing arrangement or safe harbor / profit sharing plan, and maybe $1,000 benefit in a cash balance plan. With absolutely perfect demographics, you can get that down a lot lower. Basically, the perfect demographics comes down to the spread between the owner's age and the staff's age. And so if you have a young staff and an older owner, let's say a 60-year-old owner and 25-year-old average staff age, that's where you're going to get bigger savings in a cash balance arrangement. So ADP and ACP tests. So I did define the acronyms here. Basically, if you have a safe harbor 401k plan, you get out of those tests. That's the advantage of having a safe harbor plan, is that's at least 2 fewer tests that you have to perform. And if any of you out there have ever had one of these tests performed and you failed one of the tests, it can be just a little bit of a headache to fix those issues. So you can get out of those tests by putting in a safe harbor. What you can't get out of is the 401a4 test. But if you give everybody the exact same percentage, you don't have that issue. But we'll talk a little bit about that in a couple slides. So here's a very simple example. As I mentioned, I have to put numbers in here as a good actuary is required to do. So this is slide 1 of numbers that you're going to see a bunch of other slides coming up too. Basically, this is a safe harbor plan that is, and it could be either a safe harbor match, a 3% safe harbor match, or just a 3% flat safe harbor. But this plan gives 3% safe harbor. So, so there's no need for the ACP ADP test. And you can see that we have one owner, we have two so NHC stands for non-highly compensated employee. And you can see that the company contribution for the plan in total is $10,050. And we're giving $7,050 of that, 3% of the owner's pay. We're giving that $7,050 of the $10,050 to the owner. So we're getting about 70% to the owner. Not bad, but we are only getting 3% of pay to the owner as a employer contribution. So then remember our ladder. So we started here. This Safe Harbor 401k plan is pretty close to the bottom of the ladder. Very simple, easy to understand. Not you don't have to do some complicated testing and that sort of stuff. Everybody gets 3%. It's so again simple, but not huge deductions. So how can we maybe skew this a little bit more in favor of the owner? And for those of you with a little more knowledge of DC plans, you'll recognize some of these numbers on here. But there are limits in DC plans. So DC is defined contribution. So the contribution is defined, which also means the limit on that contribution is defined. And so the limit that an individual can contribute to their DC plan is 70,000. And so you'll see that in this prior slide, we were only eating up a little over 30,000 for the owner of the 70,000 possible that he could do. And that 70,000 goes up a little bit on based on age too, with catch-ups and super catch-ups and stuff like that. But we can get more to the owner can put away more than the 30,000 that he did on the prior slide. So what does something like that look like? So this owner is over 50, and so he gets a catch up, still puts in the max deferrals that he can put in, and then we give a profit sharing of 46,500. Now, in order to do that, we still have the 3% safe harbor that we're giving staff. So we've tweaked the plan in two ways. Now it's a new comp plan. So every person is in their own group in the profit sharing allocation. And there's a safe harbor component to the plan, and the safe harbor component only applies to non-highly compensated employees. So every non-highly compensated employee gets at least 3%. And in this case, in order for the owner to get 46.5 as a profit sharing, we have to give $1,000 to these two NHCs. And that's all based on their age. This one, again, we don't have to do the ACP ADP test, but we do have to test it for non-discrimination. And it's because of their ages is the reason that $1,000 satisfies that. And so we've jumped up from not only the 7,000, what was that? 7,050 to the owner to 46,500. And again, by just giving staff a little bit more, now the 90% of the company dollars that we're putting into this plan are going straight to the owner. So we're getting there. We're moving up the ladder because now we've added complexity because new comparability it's more complex than our simple safe harbor, give everybody 3%. But by adding that little layer of complexity, we've been able to push the envelope on what we can give the owner. But now we've completely maxed out the owner on the DC side. We've maxed them out at the 77,500. We can't give them any more. So as I mentioned, that we have to pass 401A4 non-discrimination testing, and basically that just means that we can't discriminate in favor of the HCE, and that's a complicated calculation that's all based on age. You look at it at retirement, you roll everything forward to retirement. That's why you get this difference when the owner is older versus younger staff, because staff has much longer period to accrue a bigger benefit. And their pay is lower. It's all based on percentage of pay too at retirement. So the one other little kind of quirk in the 401A4 testing, and this is why if you've ever had us help you write a plan, a combo plan, we typically suggest that you don't do matching contributions, but you do a 3% safe harbor non-elective contribution, because we can use that 3% in our 401A4 testing. We can't use a matching contribution in our 401A4 testing typically. And then as you saw on the prior slide, we limited the safe harbor non-elective to the NHCEs, and that gives you the most flexibility, because again, if the demographics don't work out and you are required to give your owner 3%, that could mess up your testing a little bit, and you may have to give more to your staff. We'll see how this comes into play a little bit more when we talk about the cash balance. So let's pivot now to talk about defined benefit plans. Traditional defined benefit plans, for anybody who's close to my age or older, these are ones that you're familiar with. Social Security is a type of traditional defined benefit plan. These used to be very popular, especially in large companies and unions and things like that. Basically, what it is, well, I'll talk about kind of the advantages and disadvantages real quick. They were used in the past also by small businesses to get the large tax deductions. And the one of the drawbacks is that there are manual annual employer contributions. So these aren't optional. You can't say 1 year, nope, I don't want to give, I don't want to make the contribution that's required. They're harder to explain to employees and owners and advisors, and the liabilities fluctuate year to year, typically based on the interest rate environment. Those last two bullet points, so the last three bullet points, well, the third to last, the mandatory annual employer contributions, that's applicable to any defined benefit plan. The last two, we can alleviate some of those pain points by putting in a cash balance plan instead of a traditional. So this is a very kind of simple example of a traditional DB plan that you may have seen in the past. And basically it's a 3-year average of your comp times 10% times service, limited to 10 years. And that amount, because again, DB stands for defined benefit, we're defining the benefit at retirement, not the contribution. And so that's why everything is based on at retirement. And that's also what limits are based on and stuff like that, as opposed to these annual limits that like the DC plans have annual limits because they're limiting the contribution, because once the contribution goes in, it doesn't matter what happens between then and retirement. Whereas defined benefit plan, it defines the benefit at retirement. So throw some numbers into our example here. We have someone who has 5 years of service at retirement. Their 3-year average comp is $50,000. So they get 50% of their pay starting at retirement, paid monthly and paid for their life. So they will get $2,083 until the day they die, and they'll get that every month. Typically in traditional DB plans, lump sums aren't offered. The primary reason is because lump sums in a traditional DB plan fluctuate with interest rates. So you could have significant change in a lump sum value year over year if you have a lump sum in a traditional DB plan. So as I mentioned, there are limits in DB plans, but there are limits on the benefit. And so the benefit limit for 2025 is $280,000, and that changes every year, but that is the annual annuity limit. So somebody can start at age 65 or actually 62, and they can get $280,000 in a defined benefit plan for every year for the rest of their life as an annuity. And that's the limit. So again, we don't have the limit on the front end, the contribution. We have a limit on the back end, the total amount that they can get as a benefit. Since all of this is calculated at retirement, and it's paid for life, that's why we have to get actuaries involved. So the other kind of negative, if you will, of a defined benefit plan, which includes cash balance plans, is you have to have an actuary sign off on the numbers every year. The actuary will calculate your minimum required contribution, your maximum tax deductible contribution, because we're dealing with life expectancy here, and thus an actuary has to be involved in the calculations. So administratively, they are it's a little more of an administrative burden, and they tend to be a little more expensive because you do have an actuary involved. Okay, little fun fact here, and I don't have a way to poll everybody, but um, I'll just guess what you guys answered. But if I were to ask you, I have three people here. I have Tim Cook, CEO of Apple, Aaron Judge, outfielder for the Yankees, and an owner of a small business. Let's say a doctor, and let's say the doctor's making $500,000 a year. Who has the largest defined benefit at retirement? And spoiler alert, they're all the same. Doesn't matter. Doesn't matter that Tim Cook and Aaron Judge are not the same age. It doesn't matter that um, you know Tim Cook is making billions or whatever he's making, and the small business owner is making 500,000. The $280,000 is the annual limit at age 62, and then that gets indexed by age. So if Aaron Judge decided to retire at 33, the most he could get in a qualified defined benefit plan would be $4,100 a month. So you're talking what, a little less than 50,000 a year in benefit, which is way less than the 280. But that's because his life expectancy at age 33 is much longer than somebody's life expectancy at age 62. And so over his lifetime, he's expected to get very similar to what a 62-year-old would get by taking $280,000 um, annually for the rest of their life. So as I mentioned on an earlier slide, we can take that maximum amount, that 280, and we can convert it to a lump sum at various ages. And that's the max lump sum that they can take out of the plan at those ages. So a 68-year-old can get $3.9 million in a cash balance plan. And a 62-year-old can get 3.6 million. 62 for various reasons, and if anybody wants to see the math, feel free to reach out to me. But age 62 tends to be the most valuable benefit for somebody who's under 62. Um, but 3.6 million is what a 62-year-old can get. Now you do need to have 10 years of participation in the plan to get this, and you need to have the pay to support it because these are limited. That 280,000 gets limited to 100% of pay. So if you have an owner who's only taking $50,000 of pay, the most that they can get as an annuity at any age would be $50,000 because it's limited to that. So as long as they have the pay to meet these requirements and they have 10 years of service, they can get up to 3.6 or 3.9 million depending on their age after those 10 years. So what does it look like for a cash balance plan? Basically, for if somebody is 40 years old, they can deduct $110,000 each year in a cash balance plan. And that goes up, as I mentioned earlier, as the owner is older, they can get more. And it all goes back to this slide. If I'm 10 years, right, if I'm 52, I have 10 years to get up to that age 62, 3.6 million. Whereas if I'm 40, I have 22 years to get up to that 3.6 million. That 3.6 million doesn't change as long as I have 10 years of participation. It doesn't change based on your age. So any 62-year-old, it's 3.6 million, regardless of if they're 40 today or they're 55 today, and so on. So that's how we get to these kind of deduction numbers. And this is how we would typically would design our cash balance plan, is we would say, okay, you have an owner, a 40-year-old owner, and he makes at least 110,000, we can do a cash balance benefit of 110,000 a year. So what is a cash balance plan? Well, and why did I just bore you guys to death talking about defined benefit plans? The reason is because cash balance is a defined benefit plan. It's a special type of defined benefit plan called a hybrid plan. And it's called a hybrid plan because it looks and feels a little bit like a defined contribution plan, but it must follow all the rules of a defined benefit plan. So you must have an actuary involved. It's the benefit is what's defined at retirement. But from a plan sponsor, advisor, CPA perspective, it looks a lot like a defined contribution plan. Basically, the way that I like to think of it sometimes is a guaranteed profit sharing plan. You have a profit sharing hypothetical account or hypothetical allocation that goes in every year, and then you have interest on it, typically a flat interest amount. So it's a guaranteed profit sharing. And again, the benefit is defined. And so the benefit is what's required to be paid out of the plan um, at retirement or just when somebody terminates. So That's one of the advantages of over a traditional DB plan is basically 100%, probably 99% of cash balance plans allow lump sums, and the lump sum is the hypothetical account balance at whatever age. So if I'm working for a company that has a cash balance plan and I quit when I'm 52 years old, I can get that account balance as a lump sum when I leave the company. So another quick little fun fact about cash balance plans. I don't have to know a single thing about how the plan is invested. I don't need to know how much they've earned, what they're invested in, or anything like that. All I need is the plan document, and depending on the benefit formula, I might need salary history. But other than that, I can tell you what the benefit is owed to any individual in that plan if I have those items. And again, excuse me, it doesn't matter if the doesn't matter what the investments have done or what they're invested in or anything like that. The benefit is what's defined, not the contribution. So how does it work? Well, we have every individual in the plan has a hypothetical account, and that account gets a what's called a pay credit every year. Doesn't have to be based on pay, but it's called a pay credit. And then they also get an interest credit every year. And the interest credit for both those things are defined in the plan document. So that's why I said on the prior slide, I know what the benefit is if I have the plan document. I don't need to know what the investments have done or are doing. And the interest crediting rate is defined in the plan document. Well, in our FAQs in a couple slides, I'll talk a little bit about why rate of return is typically not very desirable because there are some rules around what you can use for the interest crediting rate. So very quick, simple example. I have a participant who has a $200,000 account balance at 1/1/25. The interest crediting is 5%, and then their contribution, I'm calling it a contribution, it's a hypothetical allocation, is 50,000 during the year. So at the end of the year, their account balance is $260,000. So if they leave the company on 1/1/2026, they can take $260,000 as a lump sum, and they could roll that over to an IRA or something. So let's go through a couple examples of what this would look like in practice. So here's a couple plan designs. Sample one, slightly more complicated than sample two. Basically, sample one is all based on compensation. So we like to do something like sample one when the owner's compensation fluctuates year over year. But sample one, the owner is going to get 75% of pay. Everybody else, all the NACs are going to get 15% of pay. Sample two is a little easier to understand and explain, but there can be complications when the owner's pay fluctuates and the owner has a down year. Sample one will kind of at least coordinate with that down year a little bit better than sample two. Sample two, it's a $150,000 allocation for the owner, regardless of what his pay is in that year. But all staff will get, the NACs will get $1,000 a year. So again, that's very simple for them to understand. We do have to do our annual non-discrimination testing like we did with new comparability, and we can define the plan. We can put everybody in their own class like we do with new comparability in a cash balance plan as well. So here's just putting some numbers to it with a sample group. We have two owners, and this is sample one. So this is 75% of pay for the owners and 15% of pay, I believe, for the staff. All the staff in this example are NHCs. So how can we enhance this a little bit or supercharge it? We can do that by combining our cash balance plan with a DC plan. And the reason we'd want to do that is because we can use the DC plan to adjust the profit sharing every year for NHCEs to pass our non-discrimination testing. So it typically, the way it works out is that providing the benefit to the employees in a profit sharing plan is going to be cheaper from a company standpoint than it would be if you provided all the benefits in a cash balance plan. So what does it look like if we combine it? Here we have two owners, and I've tweaked the plan a little bit just to keep you guys on your toes. But what we're doing here is we're maxing out the cash balance to the owners. So we are giving them the max we can give them, the highest deduction we could give them. And the staff, we're giving staff, I think it's 2% of pay. But then you can see where we make it up to the staff is in the profit sharing. The safe harbor, well, it's a combination. It's safe harbor plus profit sharing. So out of the, what is that, about $700,000, call it 710 or so, 714. You can see how much of that is going to the owners. I don't think I did the math on there. But it's more than what we were getting in just the new comparability plan, which was still pretty good. That was like 90% to the owners. This is well in excess of 90% of that, over 700,000 of company cost is going directly to the owners. So as I mentioned, the advantages are there. It's easier to understand in a traditional DB plan because the benefit is defined as a lump sum or as an account balance, whereas the traditional is defined as a accrued benefit in the future, accrued benefit at retirement, and it's a monthly accrued benefit. It's hard to get your arms around what the actual value of that benefit is for any individual. And then oftentimes the asset allocation is going to be correlated to the interest crediting rate that is part of the plan document. And so if that's the case, then you'll have assets and liabilities that move in tandem, that move together, and you don't have to worry about fluctuations in interest rates and stuff like that you would on a traditional DB plan. I'm going to skip over the tax credits under secure. So what are some of the requirements? You have to, you have an annual contribution. This is not discretionary. And typically the way it works out, especially if the assets are somewhat coordinated with the, if the investments are coordinated with the interest crediting rate, typically it's going to be really close. The required contribution is going to be close to the annual allocation. So that's typically what we recommend new plans when they set up. That's what they should budget. If you have an owner that's going to put away $300,000 in a cash balance plan, they should be comfortable funding $300,000 for at least 5 years. And you have to use a 3-year vesting. You can't use a 6-year graded like you can in other DB plans. PBGC comes into play because it's a defined benefit plan. So just keep that in mind. That's an added cost to these plans if your plan is covered by the PBGC. But there are some advantages on the back end that the owners can get more in profit sharing if the PBGC if it's a PBGC plan. Reach out to us if you'd like to see kind of what an example would be for your client and whether or not they're PBGC covered. We can talk to you about that. So I think I already mentioned who should be interested in cash balance plans. Um, and a plan, a company that's already comfortable giving employees 5% of pay in a new comp plan typically are going to be comfortable giving them, an extra couple percent and a little bit in a cash balance plan when they can get that huge bump in deduction. So these are typically the easiest ones for us to talk to who've already been maxing out their profit sharing and want to do something more. I'm not going to get into the interest crediting rate. Well, basically, the IRS has guidance on what you can use for interest crediting rate. Typically, what we do here at Nova is use a flat rate of somewhere between 3 and 5%. The actual return on assets rate that can be used, but it causes some headaches. And I won't go through all the details here, but it can cause headaches in the non-discrimination testing because remember, we're projecting everything out to retirement. So when you have a year that you have a loss, how do you project that out to retirement? You continue to project losses. And then you also have a preservation of capital that's in the hybrid rules. So you can never, your total your value of your benefit can never be less than your total contributions. So there's always a floor there, whether these employers know it or not. If they're using actual return, they have a floor there, which is basically 0%. So just a couple things to keep in mind. We do need to have good pay. So if you, we can't use things like profits. It has to be pay. So it has to be line 31 of the Schedule C, K1 line 14, or W2. W2 is the easiest and best, but for partners and sole props, if it's self-employment income, as long as you're paying self-employment tax, then we can use it. And hopefully most people know you can't deduct more than you make. Okay, I'm gonna hop ahead. I'm gonna pop this over to Scott now. Scott heads up our sales team here at Nova, and he's going to talk about he's going to talk about a big announcement we have, which somehow I stopped sharing my screen. Oh, Scott, are you there?
Hi, I'm here. Can you guys hear me?
Yep, we can hear you.
Awesome. Thank you, Phil, and thank you to everyone who's joined us today. As Phil mentioned, I do have an announcement with regards to something that we've rolled out, and hopefully several of you that are on the call are aware of one of the things that we did. And it was about 5 years ago when we actually did roll our what we call our instant solo K. And that is a tool that you can find on our website, and you can go to nova401k.com and go to the services, and you can go there. One of the things that we asked Phil and his team to do is, hey, is there a way that we can transition this from just instant solo K to then the ability to take for owner only clients, right? So this is only going to be someone who is self-employed, only someone that has no employees in their business and has earned income, as Phil had mentioned, and can we roll that out to our advisors and to their clients so that they can go online and actually do a DBDC combo, so this cash balance combo that Phil just outlined for us. And I'm happy to share that we have that ability at this point in time. That is live on our website. So to the extent that you have, want to go out and look at it, that there's things that you want to, have clients that you're talking to. The good news also to share with you is we still have time to impact somebody's 2024 taxes. So under Secure 2.0, we do have that ability that we can go out and still do a retroactive plan. Our date for the last time that we can do that is going to be July 31st. So you have time. We don't have a lot of time. If you have questions around this announcement, questions around the instant solo DB, I would suggest to you that you should reach out to your salesperson. Again, you can go to the Nova 401k website, and we have access to all of our salespeople all across the country. We have 22 folks across the country, and they would be more than happy to walk you through kind of what we've done with this instant solo cash balance combination plan. Client is able to online go in and complete all of the information that we need, and literally within minutes we'll create their plan document for both the solo K and the cash balance component, and be able to get an owner only client to that situation where they're able to fund within a couple of days, depending upon your broker dealer's requirements around setting up the brokerage account for this. It's limited to only owner only plans where organizations where they have no employees, and it must be a brand new plan, including the solo K side. So they don't have anything at all today, and we're able to get them set up and going and online. I think here's some of the numbers. Phil had referenced kind of some of the age and compensation limits. And this, again, is kind of showing you what those are. Everything is done online. Can't stress that enough. Go to nova401k.com, go to the services section, instant solo K combination cash balance is what you're looking for. And if there's any questions, please feel free to reach out to myself or any of the folks on the sales team. And with that, I will turn it back over to Ava to wrap us up for the day.
Thanks, Scott. Reminder to click on the paper icon at the top of your webinar screen for today's presentation handout and PDF form. If you're not able to download it, you can email us and we will send you the handout. For CE credit, be sure to fill out the pop-up survey once this session ends. For any other questions, please be sure to email us at webinars@nova401k.com. To view any webinars you may have missed in the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates. Thank you so much, Phil and Scott, for today's presentation, and thanks again for everyone for joining. We hope you have a great day.
Thank you.